So lately we've had a lot of our investors start to push into the larger unit type apartment building styles. So getting into that 7, 8, 9, 10 and up units. One of the main driving factors of this is that just that smaller unit market has become so flooded with investors that you're starting to get a lot more competition, a lot more money spent on these smaller units. And when you're getting into these 3 or 4 units, and a lot of them now are in that $1 million range, a lot of investors have just decided to change their focus and look towards these larger apartment buildings. So one of the issues with the commercial market right now is that the rental rates haven't been adjusted in so long in some of these units that the debt servicing just isn't there on acquisition. So our investors are really taking a look at 2 options. The first is being a very liquid investor. So you have the capital to be able to come in, put a larger down payment down on these properties. What that does is it decreases the loan to value and decreases the amount of mortgage that the investor is taking on, which mitigates how much your mortgage payment is and allows for a more favorable debt servicing ratio on the acquisition. The second option is taking on private financing. On the private financing side, the lenders aren't necessarily concerned about the net operating income or the debt servicing ratio. They're more concerned about just what is their equity position in the property. This allows the investors to be able to pick up a building that is underperforming, get in there, do the necessary renovations and turnovers in the units, get the rental rates back up, and then we can take that property out to a commercial lender afterwards and get the financing on the takeout. Now these private financing terms are often around 8 to 9%, and usually around like a 12 to 15 month term. That allows the borrower to have enough time to be able to get in and get the project completed. So on the commercial side, there's 2 types of private lenders that we're going to take a look at. There's our true hard private money lenders, and then there's our retail investors, our mortgage investment companies. Now the mortgage investment companies are going to offer your most competitive rates and terms and have some flexible options in terms of extending your term if you do need it in terms of being able to turn that building over. One thing to keep in mind with these mortgage investment companies is that the majority of them will do something called an interest reserve or an interest holdback. Now what this means is that your mortgage payment on the private side is interest only, and they're going to hold back maybe the entire term or half of the term mortgage payments directly from the advance of the mortgage. So this means that whatever that amount is, say it's $100,000, that is another $100,000 that the borrower is going to have to come up with on the down payment to make up for that difference coming from the advance of the mortgage. So in some circumstances, depending on how large the loan is, it may be more manageable, but on these higher end multi-million-dollar buildings, when you get that number into the couple $100,000, sometimes that's just not feasible for some of these borrowers when you take into consideration the costs they're going to have to do in their renovations. Now on our true hard money lenders, our individual private lenders, they may not have as competitive rates and terms or some of the flexibility, but it's true money lending. There are no holdbacks, there are no other conditions. It's full value on the loan to value with one lump sum of mortgage. So when you're taking a look at what type of option to go with, you're gonna have to take a look at all the conditions and requirements of the term in the mortgage. Is there going to be an interest reserve? Are you going to have to come up with additional funds on the down payment? And how much additional cost is that going to cost you? And then what is that interest rate going to be in terms of what are you going to be looking at from a true hard money lender? And does it make sense to go up 1% but still save a couple $100,000 on the down payment? In most circumstances, for some of our borrowers, it makes more sense to take on a slightly higher interest rate but be able to come up with less on the down payment. Now, once our investors have gotten into the mortgage, let's say it was done privately, they're able to go in there, get these rental units turned over, get the higher rent in there. Now we're able to take that building to a more conventional commercial lender and take that, get that takeout financing. For takeout financing with conventional commercial lenders, you're looking at somewhere between a 1 to a 10-year term. They do offer those longer terms, those 7 and 10 years, but the majority of our investors are looking at some sort of 3 to 5 year term. In terms of the amortization, you're looking at either a 20 or 25-year AM on the commercial side. So you're not going to get that 30-year AM like you would on the residential side with these conventional commercial lenders. Now, one of the other options we have on the commercial side is CMHC financing. This is quite different than your residential CMHC type financing. On the commercial side, it allows the borrower the opportunity to go up to an 85% loan to value and the option for a 30 or a 40-year amortization, which can drastically reduce the amount of monthly payment and increase the cash flow. Now, there are some other costs associated with the CMHC. There is a cost per door for the application, so that's something to keep in mind, and that does have to be paid up front. And then on the CMHC financing, you are going to have the CMHC premium as well too. So if you get the full 85% loan to value with a 40-year AM, you're going to have a 4.5% CMHC insurance premium that's added to your mortgage amount. Now, something to consider is, is that CMHC financing worth it when you compare to what a conventional rates and terms are going to be? For the CMHC financing, to really get those top terms and amortization, you're really going to have a top tier building. It's going to have the aesthetics, the curb appeal, and the lender's really going to want to lend on it. If you aren't in these top 2% of buildings, chances are you're not going to get the best rate in terms, and it's going to be similar to what you're going to get on the conventional side anyways. And when you take into the consideration the CMHC insurance premium as well too, that's going to be increased, and the application fees, you have a bunch of additional costs that really increase your cost of borrowing. So what we really want to do is sit down and make sure that it truly makes sense for a borrower to go with a CMHC and not on the conventional side. And most cases, it actually makes more sense for the borrower to actually take a conventional mortgage than going with the CMHC financing. Now, the other side of commercial lending is our retail commercial or mixed use commercial. So this is when we have some sort of like retail component in the building, either by itself or mixed in with residential. Now, when you have this retail component, it does change the loan to value and the amortization. In most circumstances, you're going to be at a 65% loan to value on these buildings with usually a 20-year amortization. So it does mean your mortgage payments are going to be a little bit higher. The big thing with retail commercial right now is how has the pandemic affected these companies? Are they working? Have they been producing consistent income? Have they had any shutdowns? Have they been taking any government assistance to be able to help pay the rent? There's a lot more due diligence that is involved, and having these questions, being able to give these answers to the lender is going to be able to produce a much smoother transaction and help get more top tier terms on the building. On the retail side, the tenants can play a huge part. So there's something that we call an anchor tenant. So this is going to be some sort of government building, maybe some sort of school board, a bank, an LCBO, something that everybody kind of knows. It's a top tier type lender. Having these anchor tenants in your building is going to drastically improve your chances of getting more favorable financing. When you have these mom and pop type commercial units, store-owned thrift shops or hairdresser, barbershop type things, it still looks good. And as long as there's good revenue coming in, it doesn't necessarily harm your business. But the grade A anchor tenants are definitely like a curb appeal piece for the lenders to take a look at, and they will favor that when we are submitting in an application. Now, on the commercial side, there are a few more reports which are going to add to the cost of the whole application. So the appraisal itself, which is standard, but on the commercial side, the cost is going to be a little bit higher. So on a commercial or appraisal, you're looking at a cost of around $16,000 to about $2,000, depending on the size of the building and the extent of the appraisal. Something else you're going to possibly have to have is a phase 1 environmental. So a phase 1 environmental takes a look at historical data of the building in that area. Who are the tenants? What type of industry were they in? Does it involve any type of chemicals that could potentially cause harm to the environment? So we're looking for any mechanic shops, paint companies, stuff like that. The environmental company will take a look at their dumping records to see what kind of chemicals were being used, and if anything's flagged, it may require a phase 2. Something else that phase 1 is going to do is take a look at any possible objects in the geographical area. So are there any underground storage tanks, or is your building across the road from a mechanic shop or a gas station? Again, any of these things could cause flags and possibly require a phase 2. Another report that you're going to probably need is a building condition report. Building condition report is simply that. It takes a look at the condition of the building, lets the lender know if there's any deficiencies or things that need to be immediately repaired to keep the building safe for the tenants. So we're looking at the roof, how is the HVAC systems, anything to do with fire safety as well too, windows, stairwells, exit doors, firewalls, any of those types of things. So these larger apartment buildings do require a little bit more due diligence up front, and so we're more than happy to take a look at any numbers, make sure they make sense, and if they don't quite make sense on acquisition, what type of strategies can we implement to get you in and then get you back out into conventional financing.